So without any further ado, I'd like to welcome Jessica Lehmen, who is one of our WK members. She is going to be walking through today's topic, which is sales and use tax and how the Wayfair decision impacts your business. Jessica, I'll turn it over to you.
Sales and use tax. When I started doing more of the state tax stuff, you've got the income tax side that always seemed more interesting to me. Sales tax seemed like this simple thing that didn't really deserve that much thought. But over the years, I've learned how wrong I am with that, and that sales tax is incredibly complicated. And it is the most common thing that we get questions on when it comes to state and local tax. So hopefully we can help with some of your questions today. To a certain extent, we might just be pointing out some more possible issues, but that's kind of the nature of this, of sales tax. It's so different by state, by jurisdiction, that a lot of times the answer is we're going to have to look that up. So we're just going to get into some of the issues so we know what we need to be thinking about, and then go from there if there's anything that anybody needs help figuring out. So Jennifer, since I only have one screen now, I'm going to ask you if there's anything I need to look at on the Q&A or anything as we go along. Please just give me a heads up.
Not a problem. I'll keep an eye on it.
And I will leave time at the end of the presentation to answer questions as well. So let's get started. We're going to go through the differences between what sales tax is and use tax is. So throughout the presentation, I'm going to use the names, one or the other, basically meaning the same thing, but they're not actually the same thing. And that's important to remember when it comes to determining how much you actually need to be charging somebody in tax, because sales tax and use tax aren't always the same. But some basics. Sales tax is generally from an in-state to an in-state transaction. It's imposed on the buyer, but it's collected by the seller. So you're used to paying sales tax. Every time you go to the store, you pay sales tax. So an example, you purchase computers from Best Buy here in town, you're going to pay sales tax on that purchase because both you and the seller are right here in the state of Missouri. Then there's use tax, and there's two versions of use tax, and the only difference is who is responsible for sending that tax into the state. Use tax is on an out-of-state to an in-state transaction. So generally the seller is out-of-state and the buyer is in-state, or vice versa. Again, the tax is always imposed on the buyer, but in a vendor's use tax transaction, it's collected by the seller. This is the type of tax that Wayfair is after. This is what creates the Nexus arguments, because it's an in-state, out-of-state transaction. So an example of this is if you purchase computers from an out-of-state seller who does have Nexus in your state. So you go to Best Buy online, they ship it to you from wherever. They would technically charge you a vendor's use tax. Consumer's use tax is the other side of it. So if you buy something from a seller that's out of state, that does not have nexus with the state that you're in, that doesn't mean you don't have to pay the tax. It just means that who's responsible for sending it to the state is different. So a consumer's use tax is, again, an out-of-state to an in-state transaction. It's imposed on the buyer, and it's remitted by the buyer. So pre-Wayfair, this was almost anywhere. It's hard to name a big company now that doesn't charge you use tax. But pre-Wayfair, if you purchased computers on Amazon, you probably weren't paying use tax on them. Amazon may not be the best example, but you probably weren't paying the use tax. That doesn't mean you're not required to. So every state has different rules on how this would get remitted. But for example, Missouri says that if you purchase at least $2,000 in annual purchases that would be subject to consumer's use tax throughout the year, you are supposed to go ahead and file a form and remit that tax yourself. Compliance on this at the For businesses that are needing to remit their own use tax isn't bad. The state's been after that for years. Compliance on this for individuals, I don't have the numbers, but I can only imagine it's very, very low because most people either don't keep track or aren't even aware that this is the rule. So the reason why we need to keep in mind that even though we call these taxes the same thing, generally one or the other is going to apply, but that doesn't mean that they are exactly the same thing. So just some examples. Many Missouri localities, including Columbia and Jefferson City, don't have a local use tax. So your sales tax rate buying something in Columbia versus your use tax rate if you buy something and it gets shipped to you and you live in Columbia are two different things. It makes it even more confusing because there are even certain exemptions, like Missouri has a manufacturing exemption that applies for local use tax, but not local sales tax. So not only do you have local rates that might be different, you might have exemptions that apply for one or the other. So this is where it gets overly confusing. But just a word of warning to pay attention to the fact that there is a difference between the two of these. What kind of items are typically taxable? So usually when you think of sales tax, you think of the sale of tangible goods that are sold at retail. So it's meant to only cover the final transaction. You know, wholesale items or resale items are exempt. But there's a lot of other things that can fall into sales tax, including rentals of personal property, but sometimes that's exempt if the lessor paid tax on the purchase. Some services are taxable. Some entertainment is taxable. And then you need to watch out for delivery, handling, surcharges, all these other things that you might find on an invoice. Whether or not these are taxable depends on the state and depends on the situation. So for example, Missouri specifically exempts delivery because of a whole hubbub about a court case years ago. But that doesn't necessarily mean mandatory gratuity is included or something like that. So you have to pay attention to the detailed charges as well, not just the actual product that's being sold. The taxability is so dependent on the state. So I'd go into everything assuming that the sale is taxable and then prove yourself otherwise before you get into, to keep yourself out of trouble, basically. So some common exemptions. There's some that are pretty uniform and some that aren't. So resale is almost, I can't think of an example where it's not, but resale is usually exempt. But often you have to provide a resale certificate or an exemption form to the vendor that you're purchasing from to prove that you're selling something for resale. Or on the other side, if you are the vendor, make sure you're getting resale certificates from your customers if they're claiming that they're using it for resale. Manufacturing is often fully, partially, or even not exempt, but it depends on the item and the state. So utilities going into manufacturing may be treated differently from raw materials, which would be treated differently from equipment used in the process. So that's very specific and needs to be looked at state by state. Food often has reduced rates or exemptions, but again, it's very state specific. So if you're noticing a trend about things being specific, they are. Food can be overly confusing because it depends often on whether it's hot or whether it's cold or whether it's consumed on premises or whether it's not. So there's a lot to look at when it comes to food. Services are often, but not always exempt, and it depends on the service. So some states may name a specific service that's taxable when most services maybe aren't. Nonprofits, and I should have mentioned governments as well. Nonprofits and governments usually don't charge or pay sales tax, But if you're a nonprofit, you have to apply for an exemption with the state in order to be able to claim this. And there's quite a few exemptions that are specific to the product that you're selling. So medical products are often exempt, agricultural products are often exempt. You really have no way of knowing without doing a double check with each state. So how do the exemptions work? Unless it's the product that is always exempt, usually some form of an exemption certificate is required. In some states, you have to register in order to get that because you'll have to provide a registration number. In some states, you don't. There's also a streamlined sales tax agreement certificate of exemption, and that covers multiple states. The streamlined sales tax agreement is an agreement that was entered into years ago by multiple states trying to make sales tax a little more uniform and easy to administer over multiple states. We're going to use their website for a couple different things today, as well as mentioning this exemption form here. We provided a link to this exemption form on our website as well. It doesn't always work, but sometimes when you're dealing with a lot of different states and you're dealing with some states that do go by the streamlined sales tax agreement, it's not all of them. It sometimes helps to use these forms just so you have a few less exemption certificates to keep track of. I'm going to show you what I'm talking about here. So this is the streamlined sales tax exemption certificate of it. As you can tell, it's not state specific, but this shows you the different states that might take it. So it allows you to keep track of a few less exemptions. If you're able to use this, it allows you to keep track of a few less exemption forms than you would otherwise. An example of a state-specific exemption form is the Missouri Form 149. You're probably all familiar with that. This is where you tell somebody that you are going to be a reseller, or some of the manufacturing exemptions are on here. Agricultural, some of these other exemptions are here as well. So just an example. So let's get into the Nexus questions. This is what's really, truly new in the sales tax world. Well, Nexus isn't new. Nexus has been around since the beginning of time. What we mean when we say Nexus is whether or not your connection with the state is sufficient enough to be deemed fair for you to have to be subject to that state's rules. It's prohibited in the US Constitution to unfairly inhibit interstate commerce. So over the years, there have been court case after court case after court case trying to determine what exactly does fair mean. Of course, a state's version of fair is different than a taxpayer's version of fair. So you can imagine there's been a few arguments. Specific when it comes to sales tax, there was a court case back in the early 90s, Quill versus North Dakota. Quill was a mail order company, and North Dakota said by Quill sending catalogs, shipping information into their state, they thought Quill should have to collect sales and use tax, or actually use tax in this case. Quill disagreed, and it went all the way to the Supreme Court, and the Supreme Court at that time decided that no, Quill did not need to collect, basically saying that physical presence in the state was required in order to have Nexus for sales and use tax. Examples of physical presence are having your own delivery trucks going into the state, having inventory storage, salespeople or technicians that are in the state. There's a lot of different ways to create physical presence, but those are some of the most common. So what's changed since 1992? Well, the internet. More commerce is done remotely than ever. And I'd say that numbers changed considerably since January as well, due to all the stay-at-home issues that we've been dealing with. Sales are often done online with companies that have absolutely no physical presence in the state of the consumer. And so they wouldn't be required under these old provisions to collect the use tax. And we already know that individuals are really bad on paying it in on their own. The states are hurting for revenue because, like I said, consumers don't remit the taxes they should. So over the years, states have been doing everything they can to whittle away at what physical presence was without directly challenging that old court case saying that you had to have physical presence. So there was provisions for things called click-through and affiliate nexus, to where basically if you had somebody that was related to you and physically present in a state, you therefore had to collect. There was even proposals that an app on your phone or cookies left on your computer were physical and created physical presence in a state. It was getting really, really complicated. So South Dakota decided that they were going to be the ones to directly challenge that old court case requiring physical presence. They set an economic nexus standard that said if your revenue in South Dakota for sales shipped there exceeds $100,000 annually, and if the seller had 200 or more separate transactions with South Dakota annually, or either or of these, then South Dakota said you were required to collect sales and use tax there, or use tax. As you can imagine, this got fought by a major online retailer called Wayfair. Wayfair sells furniture and home decor, and their presence is almost entirely online. So I don't even know how many states they would have a physical presence in. Obviously they would, some for inventory storage and their home offices and stuff, but for the most part, they're all online. So in 2018, in June, this court case got all the way up to the Supreme Court. The Supreme Court this time decided the world has changed enough that physical presence is no longer a requirement, and they sided with South Dakota. This decision was split, so it wasn't unanimous by any means, but the basics of it were, well, times have changed, and now we think it's fair that you don't have to have physical presence. By agreeing with South Dakota here, they basically put a stamp of approval on South Dakota's standards. Could a state set standards that are even more stringent than South Dakota's? Yes, but you don't have that same level of assurance that the Supreme Court would agree with you. If they had set the threshold at $5,000, that may have deemed to be unfair. So every other state, or almost every other state, has decided to jump onto this bandwagon as well. Most states with a sales tax now have some sort of dollar threshold, and many also have transaction thresholds as well. Missouri does not yet have one. They've decided, and I believe everybody's in agreement that it's necessary, but last year they were having issues trying to figure out how to use the money. This past session, the session got cut short because of all the COVID stuff. So we don't exactly know when that's going to change, but we know that the legislature's working on it. Now, whether that actually helps state and local budgets depends on whether you have a use tax passed. The state has a use tax. Like I said before, Columbia and Jeff City do not. So even if the legislature passes a Wayfair threshold, it only helps local revenues if those localities also have a use tax passed. This link right here, and I'm just going to bring you to it, shows the thresholds by state. This is again on the Streamlined Sales and Use Tax website. which is going to fight with me now that I'm on my laptop. Hold on. Well, I'll let you all go to it on your own from the website. It doesn't work very well for me right here. But basically, this chart on this website will show you by state what the thresholds are. So you can see down here at the very bottom, Alabama has set theirs at 250,000, which is larger than the one set by South Dakota. And they also have a compliance date of October 1st, 2018. So that's when theirs came into effect. You can see if you go down Arizona, we're not going to go through these state by state, but just some examples. Arizona brought theirs on in October 2019, and their threshold is 200,000. But then it went down to 150 and 100 in later years. So this is one of my favorite sources to get information on state by state thresholds, because not only does it provide you a good basic information and a date, and they update it pretty often. I think this was last updated in May. But it also gives you links to the state's website. So you can go to the state's website and get even more information regarding, so like we can follow through on that and get even more information from the state regarding what their thresholds are. Sometimes the one chart doesn't provide you enough information.
Perfect.
Sorry.
Okay. No, that's okay. Okay, so we had a question about where to find a list of products in Missouri that are tax exempt.
So the state's website has a pretty good spot on it. I might be able to show that to you too. So if you go to dor.mo.gov and you go to, I believe it's under business tax, which has lots of stuff in it. Should be sales and use tax in here somewhere. Sales and use tax. Sales and use tax exemptions. So this one's really handy. I don't know if every state has it quite as nice as Missouri does, but you can go in here and select something. So maybe what you're wondering about is related to medical products. You can hit search, and it'll provide you a list of all the different exemptions for medical products along with the statute that goes back to it. So obviously there's quite a few of them, but that's my favorite source to go back and get information by state. Not every state is the same. And so if you have a state that you're not having a lot of luck finding it on their website, the other options are also research services, usually that are paid. So some people have access to ones through whatever service is offering their sales tax rate information, or otherwise your accountant like us, we have research services that we can get more information on those sort of things. So if you can't find it on the state's website, or if you have any questions, by all means, contact us and we're happy to help.
Okay, Jessica, we just have one more right now that's unanswered.
Sure.
Matt is wondering, how does this impact the Missouri project exemption? Is the Missouri project exemption certificate still accepted by out-of-state sellers?
So I'm going to make an assumption by a Missouri project exemption. You're talking about a construction project exemption where the entire project is exempt because of who it's being built for? if that's the correct assumption, then everything should still be exempt the same. If that's not the right assumption, clarify the question and let me know.
He said that's correct.
Okay, so yeah, if it's exempt because you're doing it for an exempt, you know, it may be a government project, it may be well, government's most likely a nonprofit type project. It's still exempt the same as it was before. Really, the only differences are you might have more out-of-state vendors asking for your exemption certificate, whereas before they may not have asked because they weren't even required to check on it. Okay, I'm gonna get back to the presentation. So you might be feeling a little uncomfortable at this point, that you wonder if you've been doing something that's not quite right, or you haven't looked at these thresholds very closely, so you're wondering if it's an issue. How do you go about assessing yourself against these thresholds and deciding where you might have problems? So the first step is to see whether you have whether what you sell is taxable, and is it taxable anywhere. And I know that's a little bit overwhelming, but start with your home state. And some things are pretty clear, but some things require a little bit more looking around in states where you might have a lot of activity. First, and then, do you have any traditional nexus issues? So even before Wayfair, if you had physical presence in another state, you probably had an issue. This included, like I said before, delivery and company-owned vehicles, salespeople in the state, inventory storage in the state, warranty or installation work. There's lots of different things that could cause your cause physical presence, which would have required sales tax collection even before any of the Wayfair changes in 2018. Once you pass that, then create a chart of your sales by state based on where you deliver to, and your transaction counts by state. And then each of these need to be compared to each state's established thresholds, like we had on the website that wasn't showing very well on the smaller computer. So here's an example of how we'd go about doing it. So this company is a Midwestern company that sells tangible goods. They're always taxable, so that's easy. We don't have to worry about that. Home office is in Missouri, and they deliver on their own vehicles to Illinois. So we made a chart that shows sales shipped to the state over here by state. And when I do this, even though technically you have a lot of different periods that you need to look at if you look at that chart, it'll say some of them are prior calendar year, some are prior current calendar year, some of them are trailing 12 months. Just go with a 12-month period that you have complete information to get started. And then if you have to dig into more details per state later, you can do that. That at least gives you an idea of which ones might be a problem. So we've pulled that, our annual sales here and our transaction numbers here. And then we've pulled from that Wayfair sales threshold chart from the Streamlined Sales and Use Tax website that you guys have the address for. And it's given us the dollar threshold for each of these states if they have one. Missouri doesn't have one. And we've listed the Wayfair transaction threshold as well. Not all states have followed the transaction threshold. So you can see Iowa, Oklahoma, Texas, they don't care about transactions. We've created notes over here. So we can see the ones in red are ones that we've exceeded something and therefore know we have an issue. So Arkansas, we know we have an issue because we've exceeded both sales and transactions. Iowa, we have an issue because we've exceeded sales. Illinois, we have a traditional nexus issue because we have delivery activity there. Minnesota, we're underneath. Texas, we're underneath, no issues. Missouri, we have nexus, that's where our home office is and everything. Oklahoma, South Dakota, both in excess of the sales threshold. In Wyoming, we only met the transaction threshold, but regardless, we met a threshold. So this is what you do to figure out which states you might have an issue in.
Jessica, we have another question.
Sure.
Daryl is curious about what is considered a transaction. They print and mail projects nationwide. Is each piece delivered in a state a transaction, or is the job one transaction that generated the mailing?
I am not absolutely certain on that, but I can make a note of it and get back to you. I think it's based on invoice, essentially. So if you've got a bunch of different things on the same invoice, that's where one invoice with 100 different line items is one transaction. 100 different invoices would be 100, I believe. But let me make a note of that, and we can get you a better definition of what the transactions mean. So you may have determined that you have an issue. There's some states that you haven't been filing in, and you think you probably need to. What are your options to get caught up or to start filing? So there's the silent method of coming into compliance, where you just start registering and filing without dealing with prior periods. There's a lot of reasons why clients tend to choose this method, and one of them is because you just simply can't get around to getting all those old ones fixed. The other is because you don't want to offer up a bunch of sales taxes for the prior periods that you didn't collect from your customers. So since the sales tax should have been collected from the customers, if you weren't set up to collect it and now you owe it, that sales tax is coming out of your pocket, which is why non-compliance with these regulations can get pretty expensive, because you're now paying a tax that can be almost 10% that you should have never been responsible for paying. So the problem with doing silent compliance, where you just start, I realize I have a problem with California. Their compliance date was a year ago, but I'm going to go ahead and start filing today. The problem is the state can always come back to you and say, hey, you had 100,000 in sales this year. Where's last year's? And once they come back to you and ask for last year's information, you have very little room to get out of interest and penalties, because they're the ones that initiated the contact. There's no statute of limitations for returns that weren't filed. So you can't just ignore it and assume it's going to drop off the radar. It may eventually, but it's going to take a while. Like I said, if you didn't collect the tax from the customer, you now bear the burden. The amount or how many periods of back taxes you owe depends on whether or not this is a Wayfair issue. Because with Wayfair, you have specific compliance dates. So we were showing, I think Alabama's was October of 2018, but Arizona's was October of 2019. All the states have a different date. None of them are before the summer of 2018. So you've got 2 years or less at this point in which you have to go back to. Now, if it's a traditional Nexus issue, if you've been delivering to Illinois for 15 years, there's another problem, because you don't have a set time that you need to go back to, because your Nexus started well before any Wayfair compliance date. You usually, for sales tax, do have to register with the Department of Revenue at the state. So that adds a little extra work that has to be done before you can get very far into the process. And you also have to register with the Secretary of State. Sometimes. Depends on the state, as usual. Another option to get yourself caught into compliance is to use these voluntary disclosure programs. So basically, in a voluntary disclosure program, you say, oops, sorry, should have been doing this and I wasn't. Here's all my back taxes to either the Wayfair compliance date or however many years are mentioned in the state's voluntary disclosure program. 4 is very common. That would apply if you had traditional Nexus. And in exchange, you often would pay reduced or eliminated penalties, usually no reduction in the interest. Not all states have voluntary disclosure programs, but many of them do. And there's one that you can enter into through that streamlined sales and use tax agreement that'll get you in on multiple states at once. It helps in the initial application, but it still takes a fair amount of time because you still have to deal state by state once you get into the filing. Often taxpayers can start this process anonymously, so it gives you a little bit of an opportunity to negotiate with a state if you've got one where there's a particular issue. Another option that's far less common, but some states have them, is amnesty programs. I actually have a typo on this slide. This if shouldn't be there, but it's rare, but there's a potential opportunity to fix prior periods if you don't qualify for voluntary disclosure. So sometimes you can get into an amnesty program even if you've already been, say you've filed the last couple months at a state and they start an amnesty program, you might be able to go back and get in filing old months as well under the program, even though you've already been contacted. Whereas a voluntary disclosure program, once the state contacts you, you're pretty much out of luck on getting into one of those. These amnesty programs are pretty limited and they're only offered for a limited amount of time. So if you started to look, it's worth looking for these, but they're not very common. So once you decide how you want to move forward in getting yourself caught up and in compliance, what's the real how? The real how is figuring out what you owe and how you're going to go about doing these filings. So is your software even capable of calculating the location-specific sales tax on each sale? If you've got 100 big transactions every quarter, it's no big deal, but if you have thousands, how are you going to figure that out? There are over 10,000 sales and use tax jurisdictions in the United States. So once you count in all those localities, you're not going to be able to just look it up for every sale. There's a lot of software programs out there that you can either add on to your existing program or subscribe to a service that integrates with your software that helps you to determine the sales tax on each sale. Or you can do special programming if you've got specialty software programs. But you have to be careful because rates change often. So you can't just input this rate once and think you're good to go. Basically, every time there's an election, you have a potential for a rate change. Do you have the capacity to actually prepare these returns in-house, or do you need to get extra help on that too? Depending on the state, you could have to file monthly, quarterly, semi-annual, or annual. You could have to file online. You could have paper options. The forms are going to be different on every state. If your sales tax are enough, you might even have weekly deposits. It's really hard to keep track of. And next, sales tax audits are common, or at least a lot more common than income tax audits. So are you going to have the backup information to deal with these when they pop up? So if you get a sales tax audit, expect to have to provide a lot of data, including all your exemption certificates for anybody you didn't charge, and including whatever you use to substantiate your filings. There are software programs out there that do nothing but sales tax, and there are also companies that you can outsource tax filing obligations to. So, I mean, this is something that we help with. There's quite a few companies that are certified service providers through the Streamlined Sales and Use Tax Agreement that also offer the integration with your software. There's options, but it takes a little time to check out and see which one's right for you. So that's the end of it specific to the sales tax. But we're going to talk a little bit, just a few minutes, about how it might apply to other taxes that you have to pay. So is this only a sales and use tax issue? Technically, Wayfair only applies to sales and use tax. But the Supreme Court approving that you didn't have to have physical presence for sales and use tax, they've basically given the go-ahead for more states to have economic nexus provisions for income tax. There was never technically a requirement for physical presence for income tax. There are some protections for sellers of tangible personal property whose only activity in a state is the solicitation of sales of that property. It's called Public Law 86272. Those companies are protected from income tax, but they are not protected from minimum fees or non-income based taxes. And we'll talk a little bit more about that on the next slide. Quite a few states have started to create bright line factor presence thresholds based on dollar amounts of sales, property, and payroll. So it's kind of similar to the sales thresholds for sales tax, except it includes property and payroll, and it's usually a different higher dollar amount. So some states, at least as of the last time I checked, and this changes frequently, but some states that have income taxes and have these factor presence thresholds include Alabama, California, Colorado, Connecticut, Hawaii, Massachusetts, Michigan, New York, Pennsylvania, and Tennessee. So for example, California's 2019 thresholds are 601,000 sales, 60,000 property, 60,000 payroll, or 25% of the total of each of these. So if your total payroll is 100,000, you had 40,000 payroll in California, they'd say you have Nexus in California. If you exceed any of those thresholds, but you happen to be protected by Public Law 86272 because you only sell tangible personal property, you are maybe protected from California's income tax, but you still owe the $800 minimum fee. If you've been charging sales tax in California because you now meet their Wayfair thresholds, they also know you exist. So we need to make sure we're paying attention and following the rules for income taxes as well, or it's just a notice waiting to happen. So be sure, if you started adding sales on, be sure your accountant is aware of whether or not you've added other states on so they can take care of the income taxes for you as well. There's also some non-income type taxes that are becoming more and more popular. They go by lots of different names, including franchise tax, commercial activity tax, commerce tax, B&O tax, etc. So no protection is offered by Public Law 86272 on these because they're generally based on gross revenue instead of net income, and that law only applied to net income. Some deductions might be allowed, but it's not all of your deductions. Some states with these types of taxes currently include Alabama, Nevada, Ohio, Oregon, Texas, and Washington. And each of these states has a threshold that determine whether or not you have Nexus. So for example, 500,000 in sales to Texas, they say you now have Nexus. Ohio, similar amount. Each state has a different dollar amount. But these can catch you a little off guard because even if you have no net income, you can still owe taxes for these kinds of taxes because they're not net income based. So if you thought we'd get through a presentation without talking about the changes that the coronavirus has brought, well, we can't. So here are a few things that we're beginning to wonder, we don't have answers on, but that we're starting to wonder about related to sales tax and the changes in our economy and everything related to COVID-19. So the state departments of revenue have been impacted by stay-at-home orders just like everyone else. This might be slowing your current audit activity, but we don't know if that's going to last. Which ties into the next issue. Will there be increased changes in shopping habits because of the stay-at-home requirements or the economic downturn? And is that going to put even more pressure on state budgets? So will audits become more aggressive? Will more products be considered to be taxable eventually? Digital goods, services. I mean, a lot of our economy now is digital. You no longer get software on a CD anymore. So are they going to start attaching to more digital delivery? And will localities have to consider sales tax rate increases? I mean, we've all heard of the issues that cities and counties and states have had with budgets now that they're having such a hard time collecting taxes. What impact does telecommuting have on Nexus in other states. So if you're based in mid-Missouri, this probably isn't the biggest issue that you're thinking about, but think of those that are working, have their main place of business in St. Louis or Kansas City. Well, they may have half of their employees that started working from home in Kansas or Illinois. So is that going to impact their Nexus? It depends on the state. Some states have offered specific guidance that's usually taxpayer friendly related to the COVID situation. We don't know where that's going to go in the future. So what should you do next? The most important thing is if you think you have an issue, don't wait, because every single day, every time you make an out-of-state sale, that issue is growing. So work with your tax advisors to confirm your suspicions if you think you've got some problems and help walk you through the issues. If you've got a lot of them, there's a good chance you're not going to be able to deal with it in one day. This can be a big problem. So we can help you prioritize, help you figure out what you need to work on first, which items are probably a bigger issue than others, and then you can get started. So like we mentioned before, you have a couple different options on how you want to proceed. They all have their risk and their benefits, but the most important thing is to start moving on something. That is the end of my formal presentation. Are there any other questions?
I see one that's unanswered, and it's from John. He wants to know if wholesale sales to a retailer for resale count towards the threshold, or is it state dependent?
It is state dependent. So the vast majority of states, I wish that website was pulling up right and I could show you, but the vast majority of states say gross sales into the state. So you can exceed the threshold even if 90% of your sales are for resale. Now, it reduces the amount of risk you have because you may not have that many that are taxable. So how much in sales tax are you really not sending in? But that doesn't mean that you don't potentially have a filing requirement. But you really have to look at it by state. So a few of the states mention taxable sales only, but a lot of them mention gross sales. So the other thing to keep in mind related to that, if you sell to a lot of people that are exempt, I don't care what state those people are in, go ahead and get exemption certificates. So that way you have them. And if another state comes back and says, why weren't you filing here? You can say, well, sorry, I wasn't. But at least 90% of my sales weren't taxable. So you've got that in your pocket already. So start getting those if you haven't.
Okay, we have another one. Are parts used in the repair or alteration of aircraft in Missouri still exempt from Missouri sales tax?
I do not know the answer to that off the top of my head. But if you send a note to our boss email or to my email, which is just jlehmen@williamskeepers.com, I can get you a response back on that. This is the problem with offering up expertise in sales tax. There are so many different specific questions. We can't memorize them all. But we're happy to help if you just send me a message. Any other questions? Well, thank you all for attending today. If you come up with anything later on that you would like some more input on, we are happy to help, and just get started, I guess, is the question. Or even better yet, maybe you listened today and just confirmed you didn't have anything that you were behind on. So congrats if that was you.
And like we mentioned earlier, we will have this webinar available on our website later today. Jessica, if you want to advance one more slide, I think your contact information is there.
Oh, yes. Sorry about that.
So anybody that has any specific questions and would like to reach out to Jessica, her email and stuff is there. But other than that, we just thank you guys for joining us today.
Thank you, everyone.